In 1994, the bond market collapsed overnight, erasing trillions in wealth. Few saw it coming, like a ticking time bomb suddenly going off. Today, the yield curve is inverting, risk premiums are rising, and U.S. debt has soared to $37 trillion, growing by $3.65 trillion annually. The patterns are eerily similar, but the stakes are far higher. I've analyzed data from Morgan Stanley, JPMorgan, and the Federal Reserve, institutions renowned for their market insights, to uncover the signals that preceded past bond crises. Stay with me to explore the historical parallels and learn how to prepare for what's ahead. The 1994 Bond Massacre, a warning from history. Imagine waking up to find your bond portfolio lost 20% in a month. That's what happened in 1994 when the Federal Reserve shocked markets with rapid interest rate hikes. Investors who thought they were playing it safe suddenly saw their stable bond holdings evaporate. After years of low rates, the Fed changed course aggressively, raising rates 7 times in just 12 months. The parallels to today are striking. Back then, investors grew complacent after years of low interest rates, assuming the good times would last forever. Today, we're hearing a similar, higher-for-longer narrative, with many convinced that rates will stay elevated but stable. But history shows that when debt levels are high and inflation lingers, stability is often an illusion. Take the story of one investor during the 1994 crash. A retiree who had shifted his savings into long-term bonds for safety saw his portfolio shrink by nearly a quarter in just weeks. He had planned to live off the steady income from his investments, but the sudden losses forced him to rethink his entire retirement strategy. Stories like his were all too common, as the speed of the Fed's moves caught even seasoned investors off guard. The 1994 Bond Massacre didn't just hurt individuals, it toppled institutions. Orange County, California, went bankrupt after its treasurer borrowed heavily to amplify returns, betting rates would stay low. When the Fed acted, $1.6 billion in losses piled up, marking the largest municipal bankruptcy in U.S. history at the time. The key takeaway? Leverage and complacency are a dangerous mix when the Fed shifts gears. What made 1994 so brutal was the speed of the rate hikes. The federal funds rate jumped from 3% to 6% in less than a year. Bond prices, which move inversely to yields, collapsed. Long-term treasuries lost nearly 20% of their value in months. Investors who thought bonds were the safe part of their portfolios got a rude awakening. Fast forward to today, and the setup looks eerily similar. After more than a decade of near-zero rates, the Fed has been hiking aggressively to fight inflation. The difference? Debt levels are far higher. In 1994, U.S. federal debt was around $4.6 trillion, about 65% of GDP. Today, it's $37 trillion, with debt to GDP well over 120%. Even small rate moves now have a much bigger impact. The lesson from 1994 is clear. Never assume stability when debt is this high. The bond market is flashing warning signals. The yield curve is inverted, risk premiums are rising, and volatility is picking up. These are the same signs that preceded past crises. The difference this time? The numbers are bigger, the debt is higher, and the risks are more extreme. The $37 trillion debt time bomb. The U.S. national debt grows by $1 trillion every 100 days. At this pace, we'll hit $55 trillion by 2029. To put that in perspective, the entire U.S. economy produces about $27 trillion in GDP annually. We're adding debt faster than we're growing the economy that's supposed to support it. Imagine a balloon expanding far beyond the room it's in. Eventually, it's going to burst. Debt to GDP ratios above 120% historically precede financial crises. Right now, we're at 122% and climbing. Japan crossed this threshold in the 1990s and still hasn't recovered. Their stock market peaked in 1989 and remains 30% below that high. Their economy has stagnated for 3 decades. The difference? Japan's debt is mostly held domestically. Ours? Nearly a third is owned by foreign investors who could demand higher yields or walk away. Each 1% increase in interest rates now adds $370 billion to annual interest payments, more than the entire U.S. defense budget. Last year, interest on the debt surpassed spending on Medicare. Within 3 years, it will overtake Social Security as the federal government's largest expense. This isn't some distant future. it's happening now. In 2013, when U.S. debt first crossed 100% of GDP, the 10-year Treasury yield was 1.9%. Today it's 4.7%, with nearly double the debt load. Higher rates plus more debt equals exponentially larger interest costs. The Congressional Budget Office projects interest payments will hit $1.4 trillion annually by 2033. That's money we can't spend on infrastructure, education, or defense. The Treasury Department now spends more on interest than on veterans' benefits, transportation, and education combined. Every dollar going to bondholders is a dollar not going to roads, schools, or research. This isn't abstract economics. It directly impacts what the government can do for its citizens. Foreign buyers are losing their appetite for our debt. China's holdings of U.S. treasuries have dropped 40% from their peak. Japan, our largest creditor, has been reducing exposure too. The Fed is no longer buying bonds. They're letting $60 billion mature each month without replacement. That leaves domestic banks and individual investors to absorb the flood of new issuance. The government needs to refinance $7.6 trillion in maturing debt this year alone. That's like paying off your mortgage by taking out a new one at higher rates. Each refinancing locks in more expensive borrowing costs for decades. The average interest rate on outstanding debt has already jumped from 1.6% to 3.2% in just 3 years. State and local governments face the same squeeze. California pays 4.1% on its 10-year bonds today versus 1.2% in 2020. Illinois recently paid 5.3%, nearly double what it cost them 3 years ago. These higher borrowing costs mean less money for police, firefighters, and teachers. Corporate America isn't immune either. Companies refinanced debt at record low rates during the pandemic. Now they face a wall of maturities coming due. High-yield bond defaults have already doubled from last year's levels. Moody's predicts the default rate will hit 5% by early 2025. The last time debt levels were this high relative to GDP was World War II. Back then, the solution was rapid economic growth and financial repression, keeping rates artificially low. Today, with an aging population and slowing productivity growth, those options aren't available. The Fed can't keep rates low while inflation runs hot. So what happens next? How do we navigate a future where debt outpaces growth and interest costs crowd out everything else? The inverted yield curve mystery. Right now, 3-month Treasury bills yield more than 10-year Treasury notes. This inverted yield curve has predicted every U.S. recession since 1955 with remarkable accuracy. Normally, longer-term bonds pay higher yields to compensate investors for the added risk of holding them longer. When this flips, it's like a seesaw tilting the wrong way, signaling deep market skepticism about future economic growth. The current inversion is the most extreme since 2000, with the spread between 3-month and 10-year yields reaching minus 1.8% in 2023, a level last seen before the dot-com crash. While some investors argue this time is different, history suggests otherwise. The yield curve inverted in 2006, 18 months before the Great Financial Crisis, and again in August 2019, 7 months before COVID-19 triggered a market collapse. These patterns have been consistent, and the current inversion has persisted for over 18 months, longer than the periods preceding both the 2000 and 2008 recessions. An inverted yield curve reflects a straightforward economic reality. Investors expect weaker growth ahead. When they anticipate short-term rates will fall in the future, they rush to lock in longer-term yields now. This drives long-term bond prices up and their yields down. Essentially, bond traders are signaling trouble ahead, even if stock markets appear optimistic. The Federal Reserve Bank of New York uses the yield curve to calculate recession probabilities, and their model currently shows a 61% chance of recession within the next 12 months. The Fed's actions are critical here. They paused rate hikes in July 2023, despite inflation remaining above target. Historically, the Fed has stopped hiking rates 6 to 12 months before recessions begin, suggesting they see economic weakness on the horizon. Corporate bond markets echo this warning. Investment-grade corporate bond spreads over treasuries have widened to 1.5%, up from 0.9% in early 2022. High-yield spreads jumped from 3% to 5% over the same period. These shifts indicate credit investors are demanding higher compensation for risk, a typical sign of growing economic uncertainty. Bank lending standards provide another clue. The Fed's Senior Loan Officer Opinion Survey shows banks tightening standards for commercial and industrial loans. This often happens before recessions as banks prepare for higher default risks. The current tightening cycle mirrors the pace seen before the 2008 crisis. The labor market, often resilient before downturns, shows cracks beneath the surface. In 2007, unemployment was just 4.6% when the yield curve inverted. Today, it's 3.9%. While job growth appears solid, temporary help services employment, a leading indicator, has declined for 12 consecutive months, a pattern seen before the last 3 recessions. Consumer behavior also raises red flags. Credit card delinquencies rose to 3.1% in Q4 2023, the highest since 2012, while auto loan delinquencies hit 7.7%, surpassing pre-pandemic levels. These metrics often deteriorate as households struggle with debt burdens ahead of recessions. Corporate earnings add to the concern. S&P 500 earnings declined year-over-year for 3 straight quarters in 2023. Analysts project just 3% earnings growth in 2024, far below the 10% long-term average. Weak earnings often signal slowing demand, a precursor to economic contractions. The manufacturing sector is already in recessionary territory. The ISM manufacturing PMI has been below 50 for 16 of the last 18 months, indicating contraction. New orders, a leading component, remain in decline, mirroring conditions seen during the 2008 financial crisis. Housing markets reflect similar stress. Existing home sales fell to a 13-year low in 2023 as mortgage rates topped 8%. Builder confidence, measured by the NAB Housing Market Index, dropped to levels last seen in 2012. Housing typically leads the economy into recessions, and the current downturn appears severe. Commercial real estate faces even greater challenges. Office vacancy rates hit 19.6% in Q4 2023, the highest since 1979. With $1.5 trillion in commercial real estate debt maturing by 2025, much of it at higher rates, regional banks, which hold 70% of these loans, face significant risks. Global economic indicators align with these warnings. Germany's economy contracted in 2023, China faces deflationary pressures, and the global manufacturing PMI has been below 50 for 15 months. Weakness abroad often spills over to the U.S. through trade and financial channels. Stocks and bonds moving together. Why it matters. For the past 20 years, bonds acted as a safety net when stocks crashed. When equities dropped, investors fled to the security of Treasuries, pushing bond prices up. This negative correlation was the backbone of the classic 60-40 portfolio. But now, that safety net is ripping apart, and it changes everything about how you need to invest. The stock-bond correlation recently hit plus 0.60, the highest positive reading since the late 1990s. This means when stocks fall, bonds are now likely to fall too. JPMorgan's research highlights this as a structural shift, not a temporary anomaly. Their analysts warn, the era of reliable negative correlation between stocks and bonds appears over, signaling a fundamental change in market dynamics. 2022 was the first major test of this new reality. Both stocks and bonds fell simultaneously, a rare occurrence in modern portfolio history. The classic 60-40 portfolio lost 16% that year, its worst performance ever recorded. Investors who thought they were diversified were hit hard on both sides of their portfolios. The root cause lies in inflation. Historically, when stocks fell due to economic weakness, the Federal Reserve would cut rates to stimulate growth. Those rate cuts boosted bond prices, creating the negative correlation. But with inflation stubbornly high, the Fed can't cut rates even if growth slows. This removes the mechanism that once made bonds rise when stocks fell. Debt levels add another layer of complexity. With $37 trillion in national debt, interest rates now respond more to fiscal concerns than monetary policy. When investors worry about debt sustainability, they sell both stocks and bonds, creating a positive correlation where none existed before. The implications are profound. Traditional portfolio construction rules no longer apply. Diversification across asset classes won't protect you if everything moves together. Vanguard's models suggest the 60-40 portfolio's 5% average annual return over the past 20 years could drop to just 2 to 3% going forward, a sobering outlook for long-term investors. Hedge funds and institutional investors have already felt the impact. Bridgewater Associates, known for its risk parity strategies, reported significant losses as their models failed to account for this shift. These strategies relied on bonds offsetting stock declines, a dynamic that no longer holds. Retirement planning faces similar challenges. Target date funds, which assume bonds will stabilize portfolios during equity sell-offs, may no longer provide the cushion retirees expect. A 10% stock market drop could now result in an 8 to 9% portfolio loss instead of the 5 to 6% investors were accustomed to. Corporate pension funds are also at risk. They rely on bonds to match liabilities, assuming stable or rising bond prices. If bonds fall alongside stocks, funding gaps could reemerge, undoing years of progress. Even risk parity ETFs, designed for a different market regime, have struggled. The largest funds lost 30 to 40% in 2022 as leveraged bond positions amplified losses instead of mitigating them. The insurance industry isn't immune either. Life insurers hold trillions in bonds to back policies. Falling bond prices during equity stress could erode their capital buffers just when claims spike, creating systemic risks regulators are only beginning to address. Municipal bonds, once seen as a safe haven, also faltered. In 2022, munis fell nearly as much as treasuries, leaving high net worth investors exposed. Commodities like gold and oil have emerged as rare hedges, often rising when both stocks and bonds fall. However, they bring their own volatility and lack the steady income streams bonds once provided. Alternative assets such as private credit and real estate may offer some relief, but they come with liquidity trade-offs. Many alternatives also correlate more with public markets than investors realize. The Fed's balance sheet reduction amplifies these trends. When the Fed was buying bonds, it suppressed volatility across assets. Now, as they shrink their holdings, market moves have become more violent and correlated. This quantitative tightening could persist for years. Foreign buyers add another wrinkle. As China and Japan reduce Treasury holdings, the market loses a stabilizing force. These central banks often bought during sell-offs, and without them, downturns could become more severe. Duration risk has also become more pronounced. Long-term bonds, which once helped portfolios when rates fell, now hurt them as rates rise. The Bloomberg Long Treasury Index fell 39% from 2020 to 2023, a sharper drop than the S&P 500's 2022 decline. The only true hedge left is cash. But with inflation still above 3%, cash guarantees a loss of purchasing power over time. Investors now face a difficult choice. Lose money slowly in cash or risk larger losses in increasingly correlated markets. The term premium shock. There's a hidden force moving bond markets that most investors never hear about, the term premium. Think of it like a hidden fee on long-term bonds that suddenly escalates when uncertainty rises. It measures the extra yield investors demand to hold long-term bonds instead of rolling over short-term ones. After years near zero, it spiked to 0.55%, a small number, but in bond market terms, it's a seismic shift. The term premium acts as a fear gauge for bond investors. When it rises, it signals growing concern about holding debt over long periods. Right now, that fear stems from two key factors: stubborn inflation and worries about U.S. debt sustainability. Investors are demanding higher compensation for the risk that inflation might stay elevated or that the government's borrowing needs could overwhelm demand. The last time we saw a similar spike was in 2007, just before the housing bubble burst. Morgan Stanley's fixed income team recently highlighted the potential fallout. Imagine an investor who thought they were playing it safe with a bond-heavy portfolio. If the term premium keeps rising at its current pace, 10-year Treasury yields could hit 5.5%, even if the Fed stops hiking rates. That would mean another 10 to 15% drop in bond prices. For context, the Bloomberg U.S. Aggregate Bond Index already lost 13% in 2022, its worst year on record. Another drop of that magnitude could devastate portfolios relying on bonds for stability. Here's why the term premium matters. It reflects deeper concerns about the future path of inflation and economic stability, not just the Fed's short-term rate decisions. When investors believe inflation could remain volatile or that debt levels are unsustainable, they demand higher yields to compensate for that uncertainty. The New York Fed's term premium model shows it turning positive in 2023 for the first time since 2010. Historical patterns offer a cautionary tale. In the early 2000s, the term premium stayed negative as investors believed in the great moderation of stable growth and low inflation. That complacency ended with the 2008 financial crisis. Similarly, the post-2010 period saw ultra-low term premiums as central banks suppressed volatility through quantitative easing. That era appears to be over. Political uncertainty adds fuel to the fire. Debt ceiling battles in Washington remind investors of the unpredictability of U.S. fiscal policy. Foreign buyers, particularly China, have reduced their Treasury holdings, with China's dropping from $1.3 trillion to $770 billion. Inflation expectations remain elevated. The 10-year break-even inflation rate derived from TIPS hovers around 2.5%, above the Fed's 2% target. This skepticism about the Fed's ability to control inflation is baked into the term premium. Supply-demand imbalances in Treasuries exacerbate the issue. With $1.7 trillion annual deficits and the Fed no longer buying bonds, the market must absorb unprecedented issuance. When supply outstrips demand, prices fall and yields rise. The ripple effects are widespread. Mortgage rates have surged, with 30-year fixed rates hitting 8%, their highest level since 2000. About 0.75% of that increase comes directly from the higher term premium, adding $250 to the monthly payment on a $500,000 mortgage compared to 2021 levels. Pension funds and insurers, reliant on long-duration bonds, face capital shortfalls as bond values drop. Some insurers have been forced to sell assets to maintain regulatory ratios, creating a vicious cycle. Even the Fed acknowledges the term premium's impact. Minutes from their July 2023 meeting show officials discussing how its rise could tighten financial conditions, complicating policy decisions. Meanwhile, the dollar strengthens as higher yields attract global capital, creating stress for emerging markets with dollar-denominated debt, like Egypt and Pakistan. The term premium may be an obscure metric, but its effects are anything but. The Fed's impossible choice. The Federal Reserve faces a no-win situation that didn't exist in previous economic cycles. With U.S. debt now at 120% of GDP compared to 65% during the 1994 rate hikes, every policy move carries dangerous side effects. Raise rates too much, and the risk of a debt crisis looms. Cut rates too soon, and inflation could spiral out of control. There's no painless way out. In 1994, the Fed could aggressively hike rates 7 times because debt levels were manageable. Today, a 1 percentage point increase would add $370 billion in annual interest payments, money that could otherwise fuel economic growth. The Congressional Budget Office projects interest payments will consume 3.5% of GDP by 2033, more than double the 50-year average. This starkly limits the Fed's flexibility compared to past cycles. Vanguard's research suggests the neutral rate, where policy neither stimulates nor restricts growth, has permanently risen to around 3%, up from 2% pre-pandemic. This means rates won't return to the near-zero levels investors grew accustomed to, even when the Fed stops hiking. Both stocks and bonds face continued pressure in this environment. The Fed's traditional playbook no longer works. In past crises, they could slash rates by 5 to 6 percentage points to stimulate growth. With rates currently at 5.25%, they have only half that room before hitting zero. Quantitative easing also faces limits, with the Fed's balance sheet still above $7 trillion. Their policy tools are far less potent than in 2008. Corporate debt adds another layer of vulnerability. Over 40% of investment-grade bonds mature in the next 5 years, requiring refinancing at higher rates. Aggressive hikes could trigger a wave of defaults, but keeping rates too low risks reigniting inflation, which remains above the Fed's 2% target. Core PCE, their preferred measure, is stuck at 2.8%. The labor market complicates things further. Unemployment sits at just 3.9%, suggesting the economy can handle higher rates. However, job openings have fallen 30% from their peak, signaling potential weakness ahead. The Fed must decide whether to prioritize current strong employment data or the warning signs of a slowdown. Global factors further constrain the Federal. Other central banks face similar dilemmas, creating coordination challenges. The ECB recently paused hikes despite inflation above 5%, fearing recession. If the Fed stays hawkish while others pivot, a stronger dollar could hurt U.S. exporters and emerging markets with dollar-denominated debt. Banking sector stress highlights the system's fragility. The 2023 regional bank collapses showed how higher rates can cause unexpected failures. Over $500 billion in unrealized bond losses remain on bank balance sheets. Another rate hike could trigger more failures, while cuts might signal panic. Fiscal policy adds to the challenge. Despite higher rates, Congress continues running $1.7 trillion deficits, undermining the Fed's tightening efforts. Inflation expectations have also become unanchored, with consumers expecting 3% inflation long-term, according to the University of Michigan survey. Once embedded, these expectations are hard to reverse without causing a recession. The housing market underscores the Fed's dilemma. Mortgage rates near 8% have frozen the market, with existing home sales at 13-year lows. Yet, home prices remain elevated due to tight inventory. The Fed faces pressure to help buyers, but risks reigniting a housing bubble. With so many conflicting pressures, the coming Treasury market earthquake. The U.S. Treasury needs to sell $1.7 trillion in new bonds this year, an amount larger than the entire GDP of Russia. But here's the problem. The usual buyers are pulling back. China's holdings of U.S. debt have dropped to $770 billion from a peak of $1.3 trillion. Japan, once our biggest foreign creditor, is cutting back too. Meanwhile, the Federal Reserve is letting $60 billion in bonds roll off its balance sheet every month without replacing them. This leaves regular investors to absorb a tidal wave of new debt, threatening to overwhelm the market like a small boat in a storm. Recent Treasury auctions highlight the strain. Participation has hit record lows, forcing primary dealers, banks required to buy unsold bonds, to take on much larger shares. For example, in November 2023, they absorbed 18% of a 7-year note auction, double their usual share. The bid-to-cover ratio, a key measure of demand, fell to its weakest level since 2016. When demand falters, yields rise to attract buyers, which spells trouble for existing bondholders. This supply-demand imbalance could have serious consequences. JPMorgan analysts warn it might trigger another repo market crisis, like the one in 2019 when a sudden cash shortage caused overnight lending rates to spike to 10%. Back then, the Fed intervened with emergency measures. But today, the stakes are higher. Treasury borrowing needs have surged 80% since 2019. The math is daunting. The U.S. government must refinance $7.6 trillion in maturing debt this year alone. Imagine trying to pay off your mortgage by taking out a new one at double the interest rate. Each refinancing locks in higher costs for decades. The average interest rate on U.S. debt has already doubled from 1.6% to 3.2% in just 3 years. Foreign demand isn't coming back anytime soon. China is selling treasuries to prop up its currency and reduce exposure to U.S. assets. Japan's life insurers, once major buyers of long-term treasuries, are shifting to domestic bonds as Japanese yields rise. Together, these two countries used to buy 40% of treasury issuance. Now they're net sellers. The Fed's quantitative tightening removes another major buyer. From 2020 to 2022, the Fed purchased 60% of all new treasury issuance. Now they're shrinking their holdings by $60 billion per month, leaving a gaping hole in demand. Banks aren't stepping in either. After the 2023 regional banking crisis, regulators are requiring banks to hold more capital against their treasury holdings, making bonds less attractive. Commercial bank holdings of treasuries have dropped 15% from their peak. Retail investors, through mutual funds and ETFs, have become the buyers of last resort. But even this has limits. Bond funds saw $200 billion in outflows during 2022's market rout, and many individual investors remain wary. The iShares 20-plus year Treasury Bond ETF, TLT, for instance, has seen its assets shrink by 30% since 2020. The auction calendar is relentless. Quarterly refunding auctions now sell $120 billion in notes and bonds at once, testing the market's capacity to absorb debt. Long-dated bonds face particular pressure, with weak demand pushing yields higher and steepening the yield curve. The Treasury projects needing to issue $23 trillion in new debt over the next decade. That assumes no recessions, no new spending, and no further rate hikes, assumptions that seem increasingly fragile. For investors, the question is clear. How much more strain can the market take? The hidden $158 trillion liability. When we talk about the $37 trillion national debt, we're only seeing part of the picture. The real number is actually $158 trillion when you count all the unfunded promises for Social Security and Medicare. These programs have $121 trillion in liabilities that don't show up on the official balance sheet. That's like owing more than 2 houses worth of debt per taxpayer, considering the median home price is about $400,000. Social Security's trust fund will run out of money by 2033 if nothing changes. When that happens, benefits automatically get cut by 23%. For the average retiree, that means losing about $500 from their monthly check. Imagine a retired couple who relies on Social Security to cover rent and groceries. A $500 cut could mean choosing between paying for medication or keeping the lights on. Medicare's hospital insurance fund faces insolvency by 2031. These aren't distant problems, they're coming within the next decade. The math behind these programs is simple but alarming. There are currently 2.7 workers paying into Social Security for every retiree collecting benefits. By 2035, that drops to just 2.3 workers. People are living longer and having fewer kids, which means fewer workers to support more retirees. The system was designed in 1935 when life expectancy was 61. Today it's 79. Medicare's problems are even bigger. Healthcare costs keep rising faster than inflation. A 65-year-old couple retiring today will need $315,000 just to cover medical expenses in retirement, up from $245,000 a decade ago. With 10,000 baby boomers hitting 65 every day, these costs are exploding. Politicians have known about this crisis for decades. The last major Social Security reform happened in 1983, when they raised the retirement age to 67 and increased payroll taxes. But they didn't fix the underlying math problem. Now, gradual fixes are no longer an option. The Congressional Budget Office projects that by 2052, spending on Social Security and Medicare will consume 14% of GDP, more than the entire federal budget today. Add in interest payments on the debt, and we're looking at 20% of GDP just for these obligations. That leaves almost nothing for defense, education, or infrastructure. State and local pensions add another layer to the problem. Truth in Accounting estimates these plans are underfunded by $1.5 trillion. Cities like Chicago and states like Illinois have pension funding ratios below 50%. When these plans run short, they either cut benefits or demand higher taxes, both bad options. The Federal Reserve can't print its way out of this one. Social Security and Medicare are real promises that require real resources. You can't just create more doctors or hospital beds with a printing press. Inflation would make the problem worse by increasing healthcare costs even faster. Younger workers face the worst of it. A 25-year-old entering the workforce today will pay 12.4% of their income into Social Security, but may never see full benefits. The program's own trustees say it's only 77% funded over the next 75 years. That's like buying a house with a 23% down payment gap. Medicare's financial problems come from 3 directions: more beneficiaries, higher costs per patient, and inefficient spending. The program pays for 65 million Americans' healthcare, but has little power to negotiate drug prices or control costs. Every 1% increase in healthcare inflation adds billions to the shortfall. State-level solutions show how painful fixes can be. When Detroit went bankrupt in 2013, it cut pension benefits by 18%. Puerto Rico's bankruptcy cut some pensions by 25%. These precedents suggest what might happen at the federal level when money runs out. The political system seems incapable of addressing this. Social Security is called the third rail of politics. Touch it and you die. The last president to seriously reform entitlements was Reagan in 1983. Since then, both parties have avoided the issue despite knowing the math doesn't work. The dollar's looming crisis. The US dollar has dominated global trade for 80 years, but history shows reserve currencies rarely last forever. Britain's pound sterling, once the backbone of global finance, lost its reserve status in the 1940s, triggering decades of instability in their bond markets. The dollar now faces a similar trajectory. At our current pace of debt growth, its privileged status could erode within 20 years. This isn't speculation, it's a mathematical inevitability. Central banks have been quietly preparing for a post-dollar world. Gold purchases hit record highs in 2022 and 2023, with countries like China and Poland stockpiling reserves. Russia now backs its ruble with gold after being frozen out of dollar markets. Even traditionally per-dollar nations like India are settling more trade in local currencies. The BRICS bloc has launched a gold-backed trading currency to bypass the dollar entirely. These moves are like cracks forming in a once unshakable pillar of global finance. Congress is aware of the threat. Lawmakers have held hearings on creating a digital dollar to compete with China's digital yuan. The Fed's research shows 130 countries are exploring central bank digital currencies. Why does this matter? Because whoever controls the digital payment infrastructure controls the future of global finance. Falling behind here could accelerate the dollar's decline. The numbers paint a stark picture. The dollar's share of global reserves has dropped from 71% in 2000 to 58% today. While that might not sound dramatic, the pace is quickening. In the past 2 years alone, the decline matched the previous decade's total. If this trend continues, the dollar could lose its majority status by 2030, a point from which no reserve currency has ever recovered. Foreign Treasury holdings reveal the shift. China has slashed its U.S. debt holdings by 40% from their peak, and Japan, our largest creditor, has also reduced exposure. Even Belgium, often a proxy for Chinese transactions, shows declining Treasury positions. These aren't temporary adjustments. They're structural changes in how nations store wealth, with significant geopolitical consequences. A weaker dollar means less leverage for the U.S. on the global stage. Commodity markets provide another warning sign. Saudi Arabia now accepts yuan for oil, breaking a 50-year tradition of dollar-only deals. India pays Russia in dirhams for energy, and Brazil and China trade in their own currencies. Since oil and commodities underpin global trade, these deals chip away at dollar supremacy one transaction at a time. The bond market implications are severe. When Britain lost reserve status, their government bond yields became more volatile and higher overall, as investors demanded extra compensation for holding sterling-denominated debt. A similar fate could await U.S. Treasuries if the dollar weakens, with ripple effects across the entire economy. Trade patterns amplify the risk. The U.S. share of global GDP has shrunk from 40% in 1960 to 24% today. As economic power shifts, so does currency usage. The euro already accounts for 20% of global reserves, and Asia's rapid growth could further erode the dollar's dominance. Political dysfunction adds to the uncertainty. Debt ceiling standoffs and government shutdowns make dollar assets seem riskier. Each crisis chips away at confidence in the dollar's stability, further weakening its foundation as the world's reserve currency. The 2025 Bond Market Outlook. Morgan Stanley's research team has identified what they call a potential turning point of 2025 for bonds, offering a roadmap for navigating the evolving fixed income landscape. Their outlook is significant because it highlights key opportunities and risks as the economic environment shifts. Treasury yields, for instance, are projected to peak in the first half of the year, creating selective opportunities for investors. However, not all bonds will perform equally, making careful positioning essential. Here are some of Morgan Stanley's key recommendations for 2025. Focus on the 7 to 10-year Treasury segment. Analysts believe this part of the curve offers the best balance of yield and risk in a volatile environment. Be cautious with corporate bonds. Credit spreads are expected to widen, with high-yield bonds facing the most pressure. Stick to higher-quality issuers with strong fundamentals. Stick to shorter-duration municipal bonds. Rising pension costs and slowing tax revenues could stress some sectors, but essential service revenue bonds appear safer. Consider inflation-protected securities selectively. Shorter-duration tips may hedge inflation risks without excessive exposure to interest rate volatility. Explore emerging market local currency debt. Countries with strong external balances and early rate cuts could offer attractive opportunities. Morgan Stanley's fixed income strategists note that current Treasury yields already reflect significant economic weakness. For example, the 10-year Treasury yield, hovering around 4.5%, signals expectations of slowing growth and potential Federal Reserve rate cuts. If these forecasts hold, high-quality government bonds could rally as investors seek safety. However, the path to lower yields is unlikely to be smooth, with elevated volatility expected as markets process conflicting economic data. Corporate bonds face a tougher outlook. Morgan Stanley projects that investment-grade credit spreads could widen by 0.5 percentage points, while high-yield spreads may increase by 1 to 2 percentage points. This suggests corporate bonds could underperform treasuries, even if yields stabilize. The firm emphasizes the importance of focusing on issuers with strong balance sheets to mitigate risks. Municipal bonds also present a mixed picture. While tax-free yields remain appealing, rising pension obligations and slowing tax revenue growth could strain some state and local governments. Morgan Stanley advises prioritizing essential service revenue bonds over general obligation debt and recommends shorter duration munis to reduce interest rate exposure. Duration risk is another critical factor in Morgan Stanley's 2025 outlook. Long-duration bonds, such as 30-year treasuries, remain vulnerable if inflation proves stickier than expected. This is why their model portfolios emphasize the 7 to 10-year segment, which offers a reasonable yield without excessive duration risk. Inflation-protected securities, TIPS, require careful consideration. While they provide a hedge against rising prices, current break-even rates already account for significant inflation expectations. Morgan Stanley suggests shorter duration TIPS for those seeking inflation protection without taking on too much interest rate risk. Emerging market debt offers selective opportunities, particularly in local currency bonds. Many emerging market central banks raised rates earlier and more aggressively than the Fed, creating potential for rate cuts that could boost local bond prices. However, Morgan Stanley stresses the importance of country selection, favoring nations with strong external balances. The Federal Reserve's policy path remains the biggest wild card. Morgan Stanley anticipates rate cuts totaling 1 percentage point in 2025, but the timing and pace are uncertain. Delays in rate cuts could prolong bond market challenges, so the firm advises, preparing for multiple scenarios. Finally, supply dynamics and liquidity conditions will shape the bond market. With net Treasury issuance expected to exceed $1.5 trillion in 2025, supply pressures could limit price gains. Liquidity remains below pre-2022 levels, so Morgan Stanley recommends building positions gradually and using limit orders to navigate potential price swings effectively. High-yield bonds, danger or opportunity. High-yield bonds are flashing warning signs that smart investors shouldn't ignore. Right now, junk bonds offer 7 to 8% yields, tempting returns in a low-yield world. But there's a catch. Credit spreads have tightened to near-historic lows while corporate leverage keeps climbing. This disconnect suggests markets aren't pricing in enough risk for what's coming. JPMorgan's research shows high-yield spreads currently sit at just 3.5 percentage points over treasuries, barely half the long-term average, despite debt levels reaching record highs. The setup looks eerily similar to 1989, just before the junk bond market collapsed. Back then, investors chased yield without properly assessing risk. Drexel Burnham Lambert, the king of junk bonds, went under when defaults spiked, freezing the high-yield market overnight. Investors were left holding worthless paper, a stark reminder of how quickly fortunes can turn. Today's conditions mirror that period. Easy money has fueled reckless borrowing, and now the bill is coming due. Corporate balance sheets tell the real story. The average high-yield issuer now carries debt at 4.5 times EBITDA, up from 3.5 times before the pandemic. Interest coverage ratios have dropped to 3.5 from 5.0 over the same period, showing companies have less cushion when earnings slow. Yet bond prices don't reflect this added risk. It's a double-edged sword. The allure of high returns masks the growing danger beneath the surface. Default rates are already creeping up. Moody's reports high-yield defaults reached 4.5% in early 2024, more than doubling from 2 years ago. If economic growth slows as expected, Defaults could hit 5 to 6% by 2025, translating to $50 to $60 billion in bonds going bust. The pain won't be evenly spread. CCC-rated issuers face default risks above 15%, while BB-rated bonds might see just 2 to 3% defaults. For investors, this means the stakes are higher than ever. Liquidity is another concern. The high-yield market has shrunk by 25% since 2020 as many companies refinanced into loans. Fewer bonds outstanding mean bigger price swings when investors try to sell. Market makers now hold just 20% of the inventory they did pre-2020. This thin trading could turn orderly exits into fire sales when volatility spikes. The Fed's policy adds another layer of risk. Higher rates have pushed borrowing costs up dramatically. The average high-yield issuer now pays 8 to 9% interest versus 5 to 6% in 2021. Many companies took on floating-rate debt, so their payments keep rising with each Fed hike. This squeeze comes just as consumer spending shows signs of fatigue. Weaker sales plus higher interest equals trouble for marginal borrowers. Covenant quality has deteriorated too. Only 25% of new high-yield deals include strong investor protections today, down from 60% in 2010. Loose covenants give companies more leeway to take on additional debt or pay dividends that weaken their credit profile. When defaults happen, recovery rates will likely be lower without these safeguards. The maturity wall looms large. Over $500 billion in high-yield debt comes due between 2024 to 2026. Refinancing at today's rates could double interest costs for some issuers. Many companies simply won't be able to afford it. This is why credit analysts are watching 2025 so closely. That's when the refinancing wave peaks. JPMorgan's fixed income team recommends being extremely selective in this environment. They suggest focusing on BB-rated bonds from companies with strong cash flows and manageable debt loads. Their analysts highlight healthcare and energy sectors as relatively safer plays, given their stable revenues. Telecom and retail bonds, on the other hand, look riskier due to competitive pressures. The key takeaway? Quality matters more than yield when the credit cycle turns. And with economic clouds gathering, that turn could come sooner than many investors think. The municipal bond safe haven. Municipal bonds might be the closest thing to a safe haven in today's bond market mess. Imagine this, a retiree looking to protect their hard-earned savings during uncertain times. Munis offer tax-free yields around 3.5%. For someone in the top tax bracket, that's like earning 6% on a taxable bond. This tax advantage is a game changer. For someone in the 37% federal bracket, a 3.5% muni yield equals a 5.55% taxable yield. Add state taxes, and the equivalent yield jumps even higher. California munis, for example, offer tax-free income at both federal and state levels. A huge deal for high earners in expensive states. This tax break becomes even more valuable if rates rise further. And here's why it matters. State governments are in their best financial shape in decades. Rainy day funds are at record levels, and tax revenues have been strong. State and local governments have built up $136 billion in reserves, 50% more than before the pandemic. This cushion matters when economic storms hit. But not all states are equally prepared. Texas has enough reserves to run for 90 days, while Illinois can only cover 15 days. These differences highlight why location matters when picking munis. But before you jump in, there's a catch. Not all munis are created equal. Remember Detroit's bankruptcy in 2013? Or Puerto Rico's debt crisis? These cases show that even tax-free bonds can blow up if you're not careful. The key is knowing where to look and what to avoid. Vanguard's municipal bond team recommends essential service revenue bonds, things like water systems, toll roads, and airports. These services generate steady cash flow regardless of the economy. General obligation bonds, which rely on a government's promise to pay, are riskier. If tax revenues drop, those payments could get squeezed. Pension liabilities remain a major risk. Some cities have promised more than they can deliver. Chicago's pension funding ratio sits at just 45%, and Los Angeles faces $10 billion in unfunded liabilities. When pensions eat up more tax dollars, there's less left for bond payments. That's why revenue bonds, insulated from these pension issues, are often the safer choice. Default rates show that munis are generally safe. Over the past 40 years, the 10-year cumulative default rate for investment-grade munis is just 0.1%, compared to 2.25% for corporate bonds. Even during the 2008 crisis, muni defaults stayed low. Most defaults were concentrated in risky sectors like nursing homes and speculative projects. Stick to essential services, and your risk drops dramatically. Liquidity has improved since the 2020 panic. Back then, muni markets froze and prices plunged. Today, trading volumes are healthier, and ETFs have made it easier to buy and sell. Still, individual bonds often trade infrequently, which is why many investors use mutual funds or ETFs for instant diversification and daily liquidity. Interest rate risk remains a concern. Like all bonds, munis lose value when rates rise. Vanguard suggests a barbell approach, mixing short-term munis for stability with some longer bonds for yield. This balances risk while keeping tax-free income flowing. The supply-demand picture also looks favorable. Muni issuance has dropped 20% from 2020 peaks as many governments built up cash reserves. At the same time, demand remains strong from high-net-worth investors seeking tax shelters. This imbalance could support prices even if broader bond markets weaken. For families looking to protect their savings, municipal bonds offer a rare combination of safety, tax advantages, and steady income. Tips: inflation insurance or trap. Tips look like the perfect inflation hedge on paper, but the reality is more complicated. Imagine a rising escalator. The principle of tips adjusts upward with inflation, like the escalator moving higher. But at the same time, real yields, interest rates adjusted for inflation, can act like a downward pull, dragging the value of existing tips lower. This tug-of-war creates a scenario where tips can lose value even as inflation climbs, especially if real yields rise sharply. Currently, 10-year tips price in just 2% annual inflation over the next decade, which seems optimistic given that core CPI has been stuck above 3% for 2 years. If inflation runs hotter than expected, tips should provide some protection. However, rising real yields can still lead to losses. For example, in 2022, tips lost 12% despite high inflation because real yields spiked. This double hit, sticky inflation and rising real yields, can make these safe bonds riskier than they appear. Morgan Stanley's fixed income team analyzed this dynamic during past market swings. They point to the 2013 taper tantrum, when real yields surged and tips underperformed, and the 2022 bond market sell-off, which saw similar results. Their advice? Focus on short-duration tips with maturities under 5 years. These are less sensitive to rate changes while still offering inflation protection. The sweet spot seems to be 2 to 3 year tips, which balance yield and risk effectively. The break-even inflation rate is a key metric for evaluating tips. Right now, 10-year tips imply 2.3% average inflation. If you believe inflation will exceed that, tips could be a good deal. But if inflation cools faster than expected, regular treasuries might outperform. With shelter costs still rising 5% annually and wage growth above 4%, the Fed's 2% inflation target seems increasingly unrealistic. Liquidity is another factor to consider. The tips market is smaller than the regular treasury market, which can lead to bigger price swings during periods of volatility. For instance, during the March 2020 crash, tips spreads widened significantly as sellers struggled to find buyers. ETFs like TIP and SCHB can help with liquidity, but they may trade at premiums or discounts to their net asset value during turbulent times. Tax treatment adds another layer of complexity. Tips generate phantom income, as their principal adjusts upward with inflation, meaning you owe taxes on that increase each year, even though you don't receive the cash until maturity. This makes tips less appealing in taxable accounts, but less of an issue in tax-deferred accounts like IRAs. The Fed's balance sheet policies also impact tips. When the Fed was buying $1 trillion per year in treasuries and MBS, it suppressed volatility across bond markets. Now, as the Fed reduces its holdings, price swings have become more pronounced. With the Fed owning about 20% of outstanding tips, their selling could put additional pressure on prices. Corporate inflation-linked bonds exist, but carry more risk due to credit exposure. During the 2008 crisis, even strong companies saw their inflation-linked bonds plummet. Government tips remain the purest inflation hedge, despite their quirks. Historical performance shows mixed results. TIPS outperformed regular treasuries from 2003 to 2008 as inflation fears grew, but lagged from 2009 to 2019 when inflation stayed low. The past 3 years have been volatile, with big gains in 2021 followed by steep losses in 2022. This unpredictability makes timing critical. For most investors, ETFs offer convenience despite minor roll yield costs. Individual TIPS held to maturity avoid this issue, the looming stall speed danger. The economy is hitting what pilots call stall speed. That critical moment when an airplane is moving too slowly to stay airborne, but too fast to land safely. Imagine a plane struggling to maintain altitude, its engines straining as turbulence shakes the cabin. That's where the U.S. economy finds itself now. GDP growth dropped to 1.6% last quarter, while core inflation remains stuck at 3.8%. This precarious balance leaves the Federal Reserve with no easy options. Cutting rates to boost growth risks reigniting inflation, while hiking rates to fight inflation could send the economy into a nosedive. The New York Fed's recession probability model now shows a 27% chance of contraction within the next year. While not unprecedented, it's double the odds from last summer. More concerning is the trend. Each month, the needle inches closer to danger. The last time we saw this pattern was in 2007, just before the financial crisis. Back then, bond markets also signaled trouble, with yields dropping months before stocks peaked. Today, the bond market is flashing similar warnings. Corporate earnings are another red flag. S&P 500 earnings growth slowed to just 3% last quarter, down from 10% a year ago. Revenue growth has dropped even further, from 5% in 2022 to just 1.5% now. Companies are relying on cost-cutting to maintain profits, but that's a short-term fix. When earnings stall, layoffs often follow, and we're already seeing early signs of this in the tech and finance sectors. Consumer spending, the engine of the U.S. economy, is sputtering. Retail sales growth has slowed to 1.5% annually after adjusting for inflation. Credit card balances have hit a record $1.13 trillion, while the personal savings rate has plummeted from 8% during the pandemic to just 3.2% today. Americans are running out of financial runway, and that spells trouble for growth. The labor market, while seemingly strong, shows cracks beneath the surface. Job openings have dropped 30% from their peak, and temporary help services employment, a reliable leading indicator, has declined for 12 consecutive months. Wage growth is also slowing, down from 5.9% in 2022 to 4.1% today. This pattern mirrors 2007, when employment metrics weakened just before the recession hit. Manufacturing data adds to the bleak picture. The ISM manufacturing PMI has been in contraction territory for 16 of the last 18 months. New orders, a forward-looking component, remain in decline. Historically, factory activity weakens before the broader economy, and right now, it's flashing bright red warning lights. Housing markets confirm the slowdown. Existing home sales are at 13-year lows as mortgage rates approach 8%. Builder confidence has plummeted, and housing starts are down 15% from last year. Since housing often leads the economy, this weakness will ripple through related industries like construction and home improvement. Even the bond market is bracing for impact. The 10-year per 2-year yield curve has been inverted for 18 months, longer than before the 2008 crash. Credit spreads are widening, and high-yield bond defaults have doubled since last year. These are classic late-cycle signals that growth is faltering. So, with the economy teetering on the edge, what happens when external shocks, like tariffs, add to the turbulence? Let's explore that next. The tariff wildcard. Just when inflation was starting to cool, new tariffs threatened to send prices climbing again. The Biden administration recently announced sweeping new tariffs on $18 billion of Chinese imports, including electric vehicles, solar panels, and semiconductors. Economists estimate these import taxes could add 0.5 to 1% to inflation if fully passed through to consumers. While that might seem small, it's enough to keep inflation stubbornly above the Fed's 2% target. Think of these tariffs like a sudden storm disrupting a calm market sea. During the 2018 trade war, similar tariffs on Chinese goods pushed core inflation up by 0.3 percentage points. Washing machine prices alone jumped 12% in just 3 months. This time, the storm targets clean energy products critical to Biden's climate agenda, creating a contradiction. Policies meant to fight inflation may end up driving prices higher. Bond markets reacted immediately. The 10-year Treasury yield jumped 0.15 percentage points the day the tariffs were announced, a significant move in the typically steady Treasury market. Investors clearly see tariffs as inflationary, signaling higher rates for longer. The 5-year break-even inflation rate, a key gauge of inflation expectations, also ticked up after the announcement. The ripple effects could extend beyond prices. The 2018 trade war showed how quickly tariffs can scramble global supply chains. Companies relying on Chinese components faced shortages, delays, and costly redesigns to avoid tariffs. This complexity added expenses that were ultimately passed to consumers. The new tariffs could trigger similar disruptions, particularly in clean energy supply chains. China has already promised retaliation, threatening tariffs on U.S. agricultural exports like soybeans and pork. During the last trade war, such measures cost U.S. agriculture $27 billion in exports and pushed food prices up by 2%. A repeat of this dynamic could hurt American farmers and further strain household budgets. The auto industry faces unique challenges. While the 100% tariff on Chinese EVs is largely symbolic due to low import volumes, the 25% tariff on lithium-ion batteries could raise costs for U.S. automakers. Most electric vehicles rely on Chinese battery components, even if assembled domestically. Ford estimates these tariffs could add $1,000 to the cost of an average EV, making the transition to clean energy vehicles more expensive for consumers. Solar installations may also slow. The U.S. imports about 80% of its solar panels from Southeast Asia, much of it from Chinese-owned factories. The new tariffs could raise costs for solar projects by 10 to 15%, potentially slowing progress toward Biden's goal of 100% clean electricity by 2035. Higher costs mean fewer installations, ironically hindering the energy transition the tariffs aim to support. Semiconductors are another flashpoint. The U.S. is imposing tariffs on Chinese chips even as it invests billions to build domestic capacity. But building semiconductor factories takes years. In the meantime, tariffs could raise prices for everything from smartphones to cars. The Philadelphia Semiconductor Index dropped 3% on the tariff news, reflecting market concerns. For investors, the implications are clear. Higher inflation means the Fed will likely keep rates elevated longer. Traders have already pushed back expectations for rate cuts this year, with the probability of a September cut dropping from 70% to 50% after the tariff announcement. This creates emotional stakes for portfolios, as higher rates could pressure corporate bonds, particularly in sectors like autos and solar, where margins are already tight. Commodities, however, could benefit. Tariffs often lead to stockpiling of raw materials, driving up prices. Copper and lithium prices jumped on the tariff news, while gold rose as investors sought inflation hedges. These moves suggest markets expect tariffs to fuel broader price pressures. The political calculus is tricky. Tariffs poll well with voters concerned about Chinese competition, but higher prices could backfire closer to the election. The Fed faces a tough choice. Cut rates to offset tariff impacts and risk letting inflation run hot, or stay firm on inflation and risk accelerating an economic slowdown. Either way, the stakes for markets and portfolios are high. The 60-40 portfolio is dead. Here's what works now. The 60-40 portfolio, once the gold standard of investing, just had its worst year in history. That classic mix of 60% stocks and 40% bonds, long considered a safe and steady strategy, lost 16% in 2022. Why? For the first time in decades, stocks and bonds fell together. The negative correlation that made this strategy so reliable has flipped. Vanguard's research shows the stock-bond correlation recently hit plus 0.60, a dramatic shift that changes how we need to invest. For 2 decades, bonds cushioned portfolios when stocks dropped, delivering smooth 7% annual returns with minimal volatility. But in 2022, both assets crashed. Stocks fell 19% and bonds dropped 13%. Diversification failed when it was needed most. This isn't a one-off event. It's the new market reality. So what's the solution? Vanguard's analysts suggest a new approach. the 50/30/20 portfolio. That's 50% stocks, 30% bonds, and 20% alternatives. This mix could deliver similar returns to the old 60/40 strategy, but with less risk. Alternatives like commodities, real estate, and managed futures don't move in sync with stocks or bonds, providing true diversification. Backtesting shows this updated portfolio would have lost just 10% in 2022 instead of 16%. Here's how the alternatives break down. Commodities. In 2022, while stocks and bonds were crashing, commodities gained 16%. Oil, gold, and agricultural products respond to different economic forces, making them a stabilizing force. A 5 to 10% allocation to commodities can help smooth out returns. Real estate investment trusts, REITs. REITs offer 4% yields and inflation protection through rising property values and rents. While they're still stocks, they often move differently than the broader market. However, they're not a perfect hedge, as 2022 showed. Managed futures. These funds use algorithmic trading to go long or short across commodities, currencies, and bonds. The SGCTA index, which tracks these strategies, gained 18% in 2022. They thrive in volatile markets, but come with high fees and complexity. Gold. While gold didn't shine in 2022, it has historically preserved wealth during crises. Physical gold ETFs like GLD offer easy exposure, though gold's returns can be unpredictable. Infrastructure. Investments in roads, utilities, and pipelines generate steady cash flows with inflation-adjusted contracts. ETFs like IGF provide diversified exposure to this sector, which has outperformed global stocks over the past 20 years. Treasury inflation-protected securities, TIPS. Though TIPS struggled in 2022, they adjust for inflation over time. Short-duration TIPS ETFs like STIP limit interest rate risk while offering inflation protection. The key is balance. Vanguard recommends capping any single alternative at 5% of your portfolio and spreading the 20% allocation across 4 to 5 different options. Rebalancing annually ensures your portfolio stays on track. Fees and liquidity also matter. Many alternatives charge high fees, which can erode returns. Stick to low-cost ETFs whenever possible. Publicly traded alternatives offer more flexibility than private equity or hedge funds, which often lock up your money for years. The bottom line? The 60/40 portfolio isn't dead, but it needs a serious update. The 50/30/20 approach, with its focus on alternatives, global diversification, and disciplined rebalancing, offers a more resilient strategy for today's markets. Adapt to the new reality, and your portfolio will be better prepared for the future. The short-term Treasury opportunity. Right now, 3-month Treasury bills are paying 5.5% with virtually no risk. Never before have short-term Treasuries looked so attractive, offering the highest yield on cash equivalents since 2007. The inverted yield curve makes this possible. You're getting paid more to take less risk than with longer-term bonds. It's a rare opportunity, but you need to understand both the benefits and the risks before diving in. Think of it like finding cash in your couch cushions. Unexpected, but you'll want to use it wisely. A $100,000 investment in 3-month bills generates $5,500 in annual interest with minimal risk of losing principal. Compare that to a 10-year Treasury note yielding 4.5%, which comes with much higher price volatility. The shorter duration also means you can reinvest at higher rates if they continue rising. However, this strategy can backfire if rates fall faster than expected. JPMorgan's fixed income team highlights this exact risk. While short-term treasuries are appealing now, reinvesting at lower rates becomes a problem if the Fed cuts aggressively. Their advice: build a ladder of maturities instead of going all in on the shortest bills. This means buying bills that mature in 1, 3, 6, and 12 months, spreading out reinvestment risk and maintaining flexibility. The current yield curve supports this approach. 1-month bills yield 5.4%, while 1-year bills pay 5.2%. That's a smaller drop compared to the 1.5% gap between 3-month and 10-year yields. By laddering maturities, you capture most of the short-term yield advantage while hedging against rate changes. If rates rise, you can roll into higher-yielding bills. If they fall, you've locked in some higher rates for longer. Money market funds offer another way to access these yields without buying individual bills. Funds like Vanguard Treasury Money Market, the USXX, currently yield 5.3% after expenses. They provide daily liquidity and automatic reinvestment, making them ideal for parking cash. The trade-off? Yields adjust immediately when rates change, unlike individual bills that lock in rates until maturity. The Fed's policy outlook adds uncertainty. Markets currently expect 2 rate cuts this year, but inflation data could shift that. If inflation remains stubborn, short-term yields might stay high longer. On the other hand, a weakening economy could prompt faster rate cuts, causing yields to drop. Laddering helps hedge both scenarios by ensuring you always have some cash maturing to reinvest. Corporate treasurers are already ahead of the curve. JPMorgan reports that 78% of corporate cash now sits in maturities under 1 year, up from 55% in 2021. Retail investors can take a cue from this strategy, especially given the tax advantages. Treasury bills are exempt from state and local taxes, making them particularly attractive in high-tax states. For someone in California's top bracket, a 5.5% Treasury yield is equivalent to about 6.5% taxable. The opportunity cost of waiting is significant. Keeping cash in a near-zero yielding account costs you roughly 0.45% per month on $100,000, adding up to $5,400 annually. Even allocating half your cash to short-term treasuries can make a meaningful difference. Liquidity isn't a concern. Treasury bills trade in the world's most liquid market, with minimal price impact and bid-ask spreads as low as 0.01%. This makes them ideal for emergency funds or short-term savings goals. Inflation remains the biggest risk. While 5.5% beats current inflation, real returns could turn negative if price growth accelerates. A mix of short-term treasuries and inflation-protected securities, TIPS, can provide both yield and inflation protection. To simplify management, many brokerages offer auto-roll features for treasury bills, automatically reinvesting maturing bills. This hands-off approach ensures you maintain your ladder, though you'll lock in whatever the current yield is at each roll date. For most investors, 6-month bills may hit the sweet spot. They yield about 5.4%, just 0.1% less than 3-month bills, while offering more time before reinvestment risk kicks in. Splitting your allocation between 3-month and 6-month bills balances yield with flexibility. When to buy the dip? The bond market is still in the early stages of a bear market that could last several more years. History shows these downturns typically run 3 to 5 years, and we're only about 2 years into the current one. The last major bond bear market ran from 1967 to 1981, a brutal 14-year stretch where investors who bought too early got crushed repeatedly. This time likely won't be as severe, but the lesson remains. Timing matters just as much as selection when buying bonds. Have you ever jumped into an investment too soon, only to watch it sink further? That's the risk bond investors face today. Morgan Stanley's fixed income team has studied every bond bear market since 1950, and their research shows yields usually peak 12 to 18 months before the Fed starts cutting rates. With markets currently pricing in rate cuts beginning in late 2024 or early 2025, yields could top out between now and mid-2025. But in the 1970s, investors who bought bonds too early saw their holdings lose another 20 to 30% as inflation raged on. The takeaway: patience pays off when inflation isn't fully under control. So, how do you know when it's time to act? Let's break it down into a checklist of key indicators. Core PCE inflation. This needs to show sustained movement toward the Fed's 2% target. The latest reading of 2.8% is still too high. Job openings. These have fallen from 12 million to 8.8 million, but need to drop further to ease wage pressures. The Fed's balance sheet. The Fed is still shrinking it by $60 billion monthly, which adds pressure on the bond market. Each of these signals will help confirm when inflation is truly beaten and the bond market is safer to enter. Credit spreads are another critical signal. High-yield bond spreads typically widen to 5 to 6 percentage points over treasuries during peak stress. Right now they're at 3.5 percentage points, so we're not there yet. Similarly, investment-grade spreads above 1.5 percentage points often indicate serious economic risks. Currently, they're at 1.2 percentage points. Keep an eye on these levels, as they can signal when the market is pricing in maximum risk. The yield curve also plays a role. The current inversion between 2-year and 10-year treasuries needs to start normalizing. Historically, the curve begins to steepen about 6 months before recessions as short-term rates fall faster than long-term ones. Right now, it remains deeply inverted, suggesting more pain ahead for bond investors. Wait for clear signs of the inversion easing before making big duration bets. Other economic indicators provide additional clues. Corporate earnings revisions, for example, are still trending downward. S&P 500 earnings growth estimates for 2024 have dropped from 10% to just 3%, signaling more economic weakness ahead. When these estimates stabilize, it could mean the worst is priced in. Housing data is another early signal. Existing home sales have stabilized at low levels, but prices haven't fallen much yet. A broader decline in housing prices would indicate the Fed's rate hikes are fully working through the economy. Right now, prices are only down about 5% from their peaks. Finally, watch commodity prices and the dollar. The Bloomberg Commodity Index remains 25% above its 2019 average, and the dollar index is near 20-year highs. Sustained weakness in both would signal easing inflationary pressures. Similarly, bank lending standards and money supply growth are worth monitoring. When banks stop tightening and M2 money supply turns positive again, it could indicate the Fed is done fighting inflation. By following this checklist, you'll be better equipped to time your bond investments and avoid the costly mistake of moving too soon. The bond market's warning lights are flashing red, signaling risks that have preceded every major financial crisis. But here's the opportunity. Investors who act now can position themselves to profit. Next week, we'll reveal the 3 bond ETFs experts are using to safeguard their portfolios, one of which gained 18% during the 2008 crash. Preparing now isn't just smart, it's empowering. The secrets to survival lie in these 3 ETFs, and they could change everything. Hit subscribe and turn on notifications to stay ahead.